Imagine waking up tomorrow in Rabbitland and finding out that carrots suddenly cost twice as much, or that every rabbit just received extra leaf money from the government, or that the rabbit bank decided to make borrowing cheaper. Would you know why? Would you know who made the decision, the rabbit government or the rabbit central bank? Most people don't, but today you will. And the difference between these two forces, monetary policy versus fiscal policy, affects every rabbit's life, every business in Rabbitland, and every carrot grown. By the end of this video, you'll understand how leaders control the economy, which policy works fastest, which works slowest, why one can reduce inflation while the other can increase it, and how both can either save the economy or break it. So stay till the end, because once you learn this, you'll see the real world completely differently. Welcome to Rabbitland, a place where rabbits hop around, farms grow carrots, shops trade leaf money, and everything in the economy depends on the balance between leaf money, carrots, and rabbit behavior. Two big forces manage Rabbitland's economy. Monetary policy, controlled by the rabbit central bank. Think of it as the bank of rabbits. Fiscal policy, controlled by the rabbit government. Think of it as Rabbitland Congress plus rabbit president. Both try to keep the economy stable, but they use very different tools, happen at different speeds, and affect different parts of rabbit life. Before we dive deep, ask yourself, do I spend more when things are cheap? Do I save more when things are uncertain? Exactly. And that behavior is what the rabbit leaders are trying to influence. What is monetary policy? Monetary policy is all about leaf money and interest rates. The rabbit central bank controls how much leaf money exists, how expensive it is to borrow leaves, how easy or hard it is to get credit, whether the carrot economy moves fast or slow. How it works in simple rabbit language. If the rabbit bank lowers interest rates, borrowing gets cheaper, rabbits take loans, shops expand, farmers grow more carrots, spending increases, the carrot economy speeds up. If the rabbit bank raises interest rates, borrowing becomes expensive, rabbits save more, businesses slow down, carrot production drops, prices stabilize, the economy cools. Monetary policy equals controlling the hop speed of the economy. Tools of monetary policy: interest rates, raising or lowering the cost of borrowing leaves. Open market operations, buying or selling government leaf bonds. Reserve requirements, how many leaves banks must keep instead of lending. Quantitative easing, basically adding more leaves into the system. What is fiscal policy? Fiscal policy is controlled by the rabbit government, not the rabbit central bank. It deals with government spending, taxes, public programs, infrastructure projects. Think of it as how the government uses carrots and leaves to guide the economy. How fiscal policy works. If the rabbit government wants to boost the economy, it lowers taxes, gives rabbits more take-home leaves, builds carrot roads, schools, tunnels, sends stimulus leaf money, helps farms and businesses stay open. This increases spending, jobs, and carrot production. If the rabbit government wants to slow things down, it raises taxes, cuts spending, reduces programs. This removes leaves from the economy and cools everything down. Real difference. Here is the clearest rabbit-friendly breakdown. Monetary policy, controlled by rabbit central bank, adjusts leaf money and interest rates, works through banks, faster to implement. Main goal: price stability. Fiscal policy, controlled by rabbit government, adjusts taxes and government spending, works through households and businesses, slower. Main goal: economic growth and jobs. Ask yourself, do I feel the impact more when interest rates change or when taxes change? Different rabbits will have different answers, and that's the point. Why use monetary policy? To fight inflation, to boost borrowing during recessions, to influence carrot prices, to keep leaf money stable. Why use fiscal policy? To create jobs, to help struggling rabbits directly, to build infrastructure, to support farmers and businesses. Both policies aim for the same thing, a healthy carrot economy, but they do it in different ways. Types of monetary policy. Expansionary monetary policy. Lower rates, more borrowing, more carrots, faster growth. Used during recessions. Contractionary monetary policy. Higher rates, less borrowing, fewer carrots, slower growth. Used during inflation. Types of fiscal policy. Expansionary fiscal policy. Lower taxes, more spending. Used during unemployment and economic downturns. Contractionary fiscal policy. Higher taxes, less spending. used during deficit reduction periods. So what are the pros of using monetary policy? Faster to implement, politically neutral, fine-tunes economic conditions, controls inflation well. Just as there are pros, there are cons as well. Let's explore the cons of monetary policy. Doesn't directly create jobs, doesn't help the poorest rabbits immediately, can cause expensive borrowing, may encourage too much debt. Moving to the pros of the fiscal policy. Direct help to households, can create jobs fast, can build long-lasting infrastructure, useful when interest rates are already low. Cons of fiscal policy are slow, can increase government debt, can cause inflation, hard to reverse quickly. Impact on households, businesses and government. On rabbit households, monetary policy affects mortgages, loans, and credit cards. Fiscal policy affects taxes, benefits, stimulus. On rabbit businesses, monetary affects the cost of borrowing for expansion. Fiscal affects sales, subsidies, government contracts. On the rabbit government, monetary no direct impact on the budget. Fiscal determines deficits and debt levels. Ask viewers, do you notice interest rates more or taxes more? Which affects your life more? Which policy works best? There's no perfect answer. During inflation, monetary policy is stronger. During recession, fiscal policy is stronger. During crisis, both are used together. Think of it like treating a sick rabbit. Monetary policy equals medicine. Fiscal policy equals surgery. Sometimes you need one. Sometimes you need both. So now you understand why interest rates change, why taxes rise or fall, why governments send stimulus leaf money, why borrowing gets cheaper or more expensive, how carrots, rabbits, money, and decisions interact to make the whole system move. At the end of the day, monetary policy and fiscal policy are simply tools to keep rabbitland balanced. Enough carrots, enough jobs, stable leaf money, and a healthy economy where rabbits can thrive. But remember this question: if you were running rabbitland, which tool would you use first and why? Your answer tells you a lot about how you see the economy. If you found this helpful, don't forget to like, subscribe, and hop into more videos just like this.